everyone, my name is Grace Cisna. I'm the CPA on staff with ProjectionHub, and today I wanted to take a little time to walk you through our multi-unit coffee shop template. When you open the template, you're going to notice that there are several tabs colored in this light blue, followed by a number of tabs in other shades. So these light blue tabs are the input tabs on which you will input the data necessary to build the model in Excel. We're going to jump in here on the Input General Assumptions tab and just walk you through some of the inputs required to build this model, and then at the end I'll show you the output that the model will build for you as you input this data. So on the Input General Assumptions tab, you're going to set various basic assumptions to help get the model set up. So we're going to need company name, projection start date, annual inflation rate for operating expenses. As you can see on this tab, there are several cells in this light blue color. These are the input cells that you need to input data on. So light blue indicates a cell that can be changed without messing with the formulas in the Excel model. You'll see that there's input data or example data in here already in some of these light blue cells. And this is exactly that. It's example data, just showing you what kind of data we're looking for. It's not necessarily an industry standard or a recommendation. I did build this template after working with multiple coffee shops. So the data in here is reasonable for a multi-unit coffee shop, but it is not suggested data by any means. It is just example data. So on this tab, you'll fill out these light blue cells here. So starting investment, any loans that aren't specific to any unit. So if you're opening a franchise of coffee shops or a number of coffee shops, if you're taking out a loan to get that general business off the ground and not a specific coffee shop, you would enter that here. As well as fixed assets not specific to any unit. That might be a warehouse or a corporate office. That's not going to be the businesses or the buildings for each of the individual coffee shops. You might also have corporate inventory. So that, again, that's not the coffee beans and stuff at the individual shops. That would be things like coffee mugs and t-shirts, or if you have beans in the warehouse, just that inventory that belongs to sort of the business as a whole and not the individual units. Here we have a calendar of opening new units. So as you plan on opening units, you can enter their start month here between 1 and 60, and then you can also select the type of unit. So we're going to build in 3 different types of units. Here they're called the average, the low performing, and the high performing. You'll see you have a drop down menu here, so you can change that. This is to enable you to show 3 different types of units. We're not going to just force you to open 5 identical units over the years. With the 3 different types of units, you can sort of format those however you want. If you want the average unit to be, sort of medium sized, and then the high performing is going to be your largest unit. Perhaps the low performing unit is ones that are sort of anchored in a different store or more of a coffee counter or drive up service. You can sort of set that however you would like for the different types of units. And that way you can open sort of different types of units over the 5 years. You can enter up to 5 different units here. Also on this tab, we have expenses not specific to any unit. Again, things like legal startup, consulting, graphic design, bookkeeping, website, all those examples are in there. And then we also have the effective income tax rate on this tab. Once we have the general assumptions set, we're going to move on to unit-specific assumptions. So on the unit-specific assumptions tab, we're going to set assumptions for each of the 3 types of units. So on the last tab, we talked about how this model is going to enable you to open 5 units of 3 different types. We've got the average, the high performing, and the low performing unit. And again, you can sort of decide what each of those categories mean, whether the average unit, again, is just your typical coffee shop. High performing might be in a particularly busy area or a particularly large space. And low performing doesn't necessarily mean bad. It might just be one of your smaller units, or it could be anchored in a different store. So on this tab, we're going to set assumptions for those 3 different types of units. We're going to set accounts receivable terms, inventory, fixed assets for the units. So this is going to be where your real estate improvements and equipment and all those sort of startup expenses go. And then you're also able to enter a loan for each specific unit. So if you plan on taking out a loan each time you open a new unit, those would go here. And you can fill those out for the fixed assets, for the high performing unit, the low performing unit, and the average unit here. So once you have those unit specific assumptions set, we move on to the input revenue model. So on the input revenue model, you build just one model, and then we get the, and that model is the average performing unit, and then we get the revenue numbers for the high performing unit and the low performing unit, sort of based off that average performing unit, just to save you a little time in building out this model. Don't want to make you do it 3 times here. We'll start at the top actually with the corporate unit. So if you have any corporate sales, and again, we give you examples here, but online sales of bagged coffee, merchandise gift cards, etc., anything that can't be attributed to any one store. I think this would mostly be any online sales that you have, because most other sales are going to be happening at an individual store. From there, we can build this big revenue model for the average unit. So we pull in the advertising spending from the other operating expenses tab as shown here. And then the model walks you through cost to acquire a new visitor, new visitors from paid ads, new organic visitors, so visitors coming to the shop that are not from paid ads. And then we have a number of total new visitors. And then we also add in regular visitors. So once you build sort of a regular base, you're going to get lots of return visits, and those are not going to be new visits, so we're going to calculate those here. So new visitors who become regulars, and then we also have a churn rate, so regulars who leave each month. And then we have our number of active regulars here. And this goes across the model. Once we have our number of active regulars, we determine how many times they visit the coffee shop each month, so number of visits per regular month. We have this set initially a little lower in month 1, and then that sort of increases to 3.3, and that holds steady for the rest of the model. So then the model calculates out your total customer visits per month based on your number of active regulars multiplied by the number of times they're visiting per month. So once we have total customer visits, we can look at what those customers are buying each time they visit. So we have sort of a menu box here where you enter the individual items, and you can fill out this box all the way to the bottom, the average price for those items, and then the average number of purchases of that item per person per visit. So you can see here the model assumes that each person on average purchases 0.8 coffee drinks, 0.8 cocktail coffee drinks, or 0.5 cocktail coffee drinks, or 0.2 food items. So on average, that assumes that the average person purchases 1.5 items. And then the model will calculate out your average spend per person, which in this case is $8. And then you can enter a growth rate here to enable that to grow over time, whether that means your prices are going up or people are purchasing more items each time. In addition to coffee and food revenue, the model also allows you to have merchandise revenue. So we've got this little model here for % of customers purchasing merchandise, and then average spend when they purchase merchandise, and again, a growth rate for that average spend. So then we summarize that for the total revenue down here for this average unit. The coffee and food revenue is calculated by the number of customer visits times the average spend per customer. And the merchandise is number of customer visits times 5% in this case, the number of customers purchasing merchandise times that $15 in the first month, and that gets us our merchandise revenue. So if we add those together to get our total revenue for the average unit, you can see this goes across for all 60 months. And then from there, we determine the high performing unit and the low performing unit just by using a percentage. So in this case, we're assuming the high performing unit performs 10% better than the average unit, and the low performing unit is 10% worse. So we enter those units here, but you can see they're in light blue, so you can fill those out to be whatever you would like, and that calculates out our revenue for the high performing and low performing unit really quickly there. Once we've calculated revenue, we move on to direct expenses. So this is food and labor cost. So we calculate the direct expenses. Well, we start with the corporate revenue. So remember that little bit of corporate revenue that we calculated up here at the top. If there's any cost of goods sold or direct expenses associated with that, we can enter that here. Right now it's set to 25% of revenue is going to be considered cost of goods sold. And then for the rest, for the actual coffee shops, not the corporate unit, we're going to look at materials and labor. So for coffee and food, we've got our food cost set, and then merchandise, this would be our direct cost of the merchandise here. And then we also have our labor. So labor is calculated out based on your number of customer visits and the number of hours open per week. So you fill out the number of hours open per week, extra hours on either side of the business day, so opening and closing hours, your hourly rate for employees, and then we fill out transactions per hour per employee and minimum employees per hour. So what the model does is it takes the number of transactions per day and then figures out the number of transactions per hour based on this info that you've entered here. And it judges how many employees you need based on this number here. So right now we have 30 transactions per hour per employee. So in the first month, we must have something less than 60 transactions per hour per employee, because you also set the minimum employees per hour. So it's never going to drop below there. So you see with 2 employees, that means you could have up to 60 transactions per hour. So the first several months in the average, it is below 60. And then here it's going to jump above 60. And so it's going to recommend that you have more than 2 employees per hour. And that increases over time. So that's a good way to get our labor expense to increase with our sales in sort of a reasonable way. And so you can see the model does the same math for each of the different types of stores. So for the high performing store, obviously you hit more transactions per hour sooner because there's more revenue being generated. And for the low performing store, it's a little bit later. So then the model takes those values out here and calculates your cost of goods sold, so your direct labor and direct materials. So total COGS for the corporate units, just based on this 25%. And then we have the direct materials based off this box here for each individual unit. And then direct labor is based off this here. Okay, the next tab is the Input Operating Expenses tab. So you'll recall in the Input General Assumptions tab, we figured out operating expenses for the corporate unit. So this Input Operating Expenses is just for the actual coffee shops, the average, the high performing, and the low performing unit. So you can enter in the average unit again. We're going to start with the average unit, and then we'll look at the high performing and low performing unit as sort of a percent difference from the average unit. So you can enter in the individual expenses, their flat monthly rate here, and you'll note that even when it says remainder of year 1, so that's going to be months 4 through 12, but this is the actual monthly amount. So for month 4, it's going to put 500, month 5 will be 500, etc. And the same for year 2. So this is month 13, starts year 2, it'll be 515 for month 13, 515 for month 14, etc. So these are still the monthly amounts here. And then you can also set the percent change for high performing and low performing units. So in this case, all of our expenses are 5% higher for high performing and 5% lower for low performing, but you're able to set those to whatever amounts would be appropriate for your business. Our last input tab here is salaries and dividends. So salaries would be the salaried employees that aren't covered in that direct labor calculation on the direct expenses. And then dividends would be distributions to any owners. So here we can set the number of employees based on the type of unit. So we have the average, the high performing, the low performing, and then of course the corporate unit. So for example, we'll look at manager. Let's say we've got a manager whose starting salary is $45,000. They start in month 1 and they continue through the model. So the model is 60 months long. So they go through month 60. You're able to enter an annual salary increase here. And then let's say for the average unit, we have 1 manager at $45,000. For the high performing, we have 2 managers at $45,000. For the low performing, we have no managers at the $45,000 rate. And that is because here we've got a manager specific to the low performing store who's at $35,000. So you can see there's none of those managers for the high and average, and then we have 1 entered here for the low performing unit. Then we also have a CEO and a bookkeeper who are part of the corporate entity and therefore are we've got 1s in this corporate column and 0s in the other columns here. So that is how you sort of enter the employees based on the type of unit. And dividends here, these are going to show up just on the cash flow statement and the balance sheet as direct payments out to the owners. So this is not an expense that shows up on the income statement, but rather just a distribution of earnings. It shows you your cash balance at the end of each month here, so you know how much could be distributed. Obviously, you can't distribute more cash than you have already. And we have this note here that all the tabs to the left, once they've been completed, are the input tabs, and everything to the right of this are the output tabs. So let's take a look at our output. So we first have this at a glance tab, which is several nice graphs and charts showing you your profit and loss at a glance, some key ratios. We've got a break-even calculation here, and these are ready to sort of be snipped out and put into a pitch deck. And then we have the actual financial statements. So the financial statements start at kind of the macro level and then break down into smaller pieces as we go. So let's look at the income statement summary. So this is a real high-level summary here. We've got sales, total cost of goods sold, operating expenses to get down to our net income. We have these real high-level summaries. You'll see them for every year. For each of the 3 financial statements that we provide, the income statement, the balance sheet, and the cash flow statement. And then we have the income statement broken out into a much more detailed amount for each of the months. So we've got months 1 through 12 in year 1, 13 through 24 in year 2, etc. And we also break out each section by the different units. So we've got the corporate unit, units 1 through 5, and then the model is going to note what you selected. So this is one of the average units, low performing, high performing, low performing. That is coming from our input general assumptions tab right here. So let's change unit 2 was low performing. Let's change it to average. And let's go to our consolidated income statement. Yeah, you can see unit 2 is now an average unit. So that's going to change the amount of revenue that's brought in each month from the unit. So it's pulling all the data from what you've just entered based on the type of unit and pulling it through to an income statement. So we've got sales, cost of goods sold, and then operating expenses for each type of unit. You'll see units 1 and 2 are now identical. They're both average units. So in their first month, they both have $15,466 in revenue, which increases to $21,561. If we went back and changed unit 2 back to a low performing, we're going to see now it's a low performing unit, and our revenue in month 1 of unit 2 is $13,919. Our first month of operations for unit 2 is month 8, and again that also comes from this here. You can see our month that it's opened is month 8, and unit 3 is high performing and starts in month 16. So if we come back to our consolidated income statement, we scroll down to month 16 here, you'll see that unit 3 jumps in with starting revenue in month 1 of $17,012. So that is kind of how the model works. It picks out what type of unit and its month start date, and it flows through into this consolidated income statement here. We do the same for the cash flow statement. So cash flow is really similar to income statement, but it includes some extra items. Cash from financing investing, so any cash from loans or new investments would go here. So you can see when a new unit starts up, we've got a purchase of fixed assets here. So this is a new unit starting. Unit 1 starts in month 1. Unit 2 starts in month 8. So in the month before that, in month 7, we have all those new fixed assets being purchased, the new equipment and the renovations to the facility and all that. So that is the cash flow statement. The balance sheet, again, is similar. Obviously, the balance sheet items here, you'll see that our balance sheet always balances. That's one of the hardest parts of building your own financial model, but you're never going to have to worry about that with ours. It will balance on its own. So we start with our cash balance, and then we have any current assets. So these are going to be things like cash and accounts receivable and inventory. Fixed assets, again, these are your buildings, your equipment. So you can see that being purchased every time we add a new unit. Again, we had a new unit in month 16. So month 15, we purchase all those items, so the fixed assets get added in there. And then from the consolidated financial statements, we have the breakdown of each individual type of financial statement. So this is showing you what each of the individual financial statements look like. So we've got the average unit, the high performing unit, the low performing unit, and then the corporate unit here. And this is just going to be in the very first month. So if you recall, our average unit had $15,466 of revenue in the first month. And so that $15,466 shows up in our consolidated income statement here for unit 1, which is average. And then our high performing unit here has $17,012 of revenue in its very first month. And so we can come back here and find our first high performing unit is unit 3 here, and then unit 5 is also high performing. So unit 3, there's that $17,012 when it starts in month 16, and unit 5 starts in month 30, and there's that $17,012. So these are just showing you what data is getting pulled through to the consolidated financial statements. It also has the individual breakdown of the operating expenses, of the sales, and the cost of goods sold. So these are all just shown in summary on the consolidated file, but here they are broken down individually for all 60 months of the model. We have this same sort of layout for the balance sheet and the cash flow statement as well. You can see that the cash for each of the individual types is negative on some occasions, and that is just for the individual units, so that means that they're requiring extra cash flow. But you can see here, let's actually take a look at the consolidated cash flow statement, that our cash at the beginning of the period is doing okay, and it takes a slight dip when we purchase new assets. But that is doing well over time. So despite the fact that some of the individual units eat some of that cash flow when they first open, sort of the model as the whole is that the other units support that over time. So that is a brief overview of our multi-unit coffee shop template. It is a very in-depth template. It is very useful. You can add up to 5 different units of 3 different types. And if this model works for you, but you need some modification, please reach out to us at support@projectionhub.com. We are able to modify models for you, and we'd be happy to do so if you need some modifications to the model to make it work for you. We're also happy to fill out the model for you. So if you purchase this and dive in and decide that you'd rather have somebody else do the work for you, again, reach out to us at support@projectionhub.com, and we would be happy to fill it out for you.